US stocks rise again with hopes a dominant Trump presidency will be good for growth and profits. But US Treasury yields fell ahead of the Fed's decision this morning on doubts Trump will be able to get all his new tariffs and borrowing past a hawkish Republican Senate. The Bank of England cuts, but looser British fiscal policy may slow more cuts. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ economist Vicky Xiao explains how well China is prepared for Trump's new tariff regime.
We believe China is better prepared for Trump Tariff 2.0 due to its prior experience with Trump 1.0 and the range of actions it can take.
But first, in 5 and 5 with ANZ, US stocks kept rising overnight to fresh highs, and bond yields, though, retraced some of their immediate jump in the wake of Donald Trump's sweeping victories in US elections. As of 4 a.m. Sydney Melbourne time, which remember is 2 hours before the FOMC is expected to cut the Fed funds rate by a further 25 basis points, the S&P 500 was up 0.6%, and the US 10-year Treasury yield down 6 basis points to 4.37%. The US dollar index fell 0.6%. ANZ's head of G3 Economics, Brian Martin, said this morning from London, before the Fed decision, that markets have taken another closer look at what Trump might actually be able to get through Congress, including the prospects for inflationary tariff hikes and big US government borrowing.
People are just now beginning to get a little bit more cautious about the extent to which Trump will introduce blanket tariffs on competitor nations like China and Europe. Certainly, that could disrupt the supply side of the economy, would be bad for growth. And we know Trump is a businessman, the Republicans are the party of business. So it's not clear to me that they are going to just come in and knee-jerk raise tariffs across the board for everybody. But also as the market is trying to assess what is the likelihood for the path of the budget, they're now taking into considerations things like significant government savings from efficiency measures. They're beginning to think that Trump will not be permitted to expand the budget deficit that aggressively. He still has to deal with the Republicans in the Senate, and they are quite hawkish.
With that US dollar index down with Treasury yields, the Aussie dollar is up 1.5% to 66.68 US cents as of 4 a.m. Sydney Melbourne time, while the Kiwi was up 1.36% at 60.19 US cents. Number 2, the Bank of England cut its cash rate overnight by 25 basis points to 4.75% and said disinflation had happened a bit faster than it had forecast in August. However, the new Labour government's new budget has added some stimulation to the economic outlook over the last week, and that's changing the equation for the Bank of England.
Bank of England is now expecting inflation to pick back up. For the end of this year, it's now looking at inflation to be 2.4%, and that compares with 1.7% in September. But as far as the budget is concerned, they actually predict now that it will add 0.5% to inflation over their forecast horizon, and that inflation now will not return to target until the second quarter of 2027. So if anything, the inflation landscape is pointing to a gradualist approach to reducing interest rates.
Number 3, the Fed is expected to cut the Fed funds rate by 25 basis points to a range of 4.5% to 4.75%, just as we publish at 6 a.m. Sydney Melbourne time. Brian says there are growing expectations the Fed will cut another 25 basis points next month as the US labour market moderates. That was reinforced overnight by data showing US jobless claims rose 3,000 to 222,000 last week. There was also a rise in continuing claims, implying it's taking longer for unemployed workers to get new work. Number 4, Australia's trade surplus fell nearly $700 million to $4.6 billion in September as exports fell 4.3%, although that was more than a 3.1% fall in imports. ANZ economist Sophia Angala says exports to all of Australia's major trading partners dropped, except to China.
Exports to China ticked up to $14 billion following a fall to their lowest level since February 2022 in July. And this is actually still up compared to the pre-pandemic level of $12 billion in September 2019. And if you actually look through the export volume data from August to September, we actually saw an uptick in iron ore export volumes going out to China.
Number 5, China's exports rose 12.7% year on year in October, the fastest rate in 2 years, while imports undershot estimates, falling 2.3%. ANZ economist Vicky Xiao says factories boosted output ahead of the US election in anticipation of new tariffs.
With a lot of uncertainties around how much tariff will Trump pose on Chinese product, exporters will likely to front-load those shipments before the formal announcement, which will boost the export figures for the rest of 2024.
Vicky, Xiao, there, who we stay with for our bonus deep dive interview on the implications for China-US trade after Donald Trump's election win and the prospects for 60% tariffs.
China has become a key focus after Trump's win. We do not expect an immediate 60% of tariff hike for China in 2025. Instead, we expect the new US administration to bring back the original plan of Trump 1.0. Our baseline scenario is that additional tariffs will be implemented in two phases. First, restore 30% of tariff on list 1 to 3 under section 301 and 15% tariff on list 4A and 4B. This will lift the average tariff to 22% from the current level of 13%. Second, additional 10 to 15% tariff punishment on all lists. In that case, average tariff will be around 32 to 37%.
So exactly how prepared is China for this?
So we believe China is better prepared for Trump tariff 2.0 due to its prior experience with Trump 1.0 and the range of actions it can take. First, China is likely to introduce tariffs on U.S. agricultural and energy products, turning into the alternative market like Brazil and Australia. Additionally, China may implement stricter export controls, particularly on critical minerals, and impose higher barriers for U.S. companies seeking access to Chinese market.
So China's been using the last 4 years to increase friendshoring, producing goods in other countries in order to export them to the States. Is that going to be allowed to continue, do you think?
The significance of US in China's export landscape has decreased since the onset of US-China trade war in 2018, with its share falling from 19% in 2018 to 11% of today's export by October 2024. In response, China has begun to diversify its trading partners, placing greater emphasis on regions like ASEAN, BRICS, and Saudi Arabia. As of October 2024, ASEAN has emerged to be the largest trading partner of China, showing a year-on-year growth of 8.8%.
So how have markets in China reacted over the last couple of days?
We have observed some weakness in the Chinese market, but it remains overall quite resilient. The Hang Seng Index dropped by 2%, but the CSI Index only fell by 0.5%. CNY depreciated against the USD, reaching 7.17 after rising from a low of 7.12, influenced by a rally in the US dollar. Although the market was expected to be quite volatile yesterday, it turned out to be relatively quiet. The Chinese bond market also remained stable, with the 10-year government bond yield holding steady at around 2.11%.
Is that because there's a new stimulus announcement expected in coming days?
I think the relatively stable reaction from China market is mainly because Trump win wasn't unexpected. A lot of traders or market participants has already priced in Trump's win in their trade. So that's why yesterday's reaction wasn't really dramatic. But of course, everyone is waiting for the NPC announcement on stimulus due by Friday. That will give China's economy a strong boost.
Vicky, Xiao, there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, November the 8th. Catch you next week with reaction to the FOMC's decision today, which is being announced just as we publish. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.